There's a moment in every financial cycle when the noise begins to fade, not because the danger has passed, but because most people have stopped listening. Markets don't collapse with a scream. They weaken in silence. And right now, beneath the surface of global finance, silver is telling a story that very few are prepared to hear. For decades, silver has existed in the shadow of louder assets, equities chasing momentum, real estate inflated by cheap credit, cryptocurrencies promising digital salvation. Silver, by contrast, has remained inconvenient. It doesn't generate yield, doesn't fit neatly into modern financial narratives, and yet it sits at the intersection of money, energy, industry, and trust. When something begins to break in that intersection, the consequences don't stay contained. What we're seeing now isn't a price story. It's a structural one. Silver is in trouble, not because it lacks value, but because the system that prices it no longer functions the way people believe it does. For years, investors were taught to think of silver as volatile, speculative, and secondary to gold. But volatility doesn't come from metal. It comes from leverage. It comes from paper claims multiplying faster than the physical asset beneath them. That's where the first crack appears. Today, the global silver market operates on an illusion of abundance. Paper contracts represent quantities of silver that simply do not exist in physical form. This isn't theory, it's arithmetic. Futures markets, exchange-traded products, unallocated accounts, all of them promise exposure without possession. The same ounce is effectively sold dozens, sometimes hundreds of times over. That structure only works under one assumption, that most holders will never ask for delivery. That assumption is starting to fail. Industrial demand for silver has changed dramatically. Solar energy alone now consumes vast and growing quantities of the metal. Electrification, medical technology, defense systems all require silver's unique conductivity and reliability. Unlike gold, silver is not just stored, it is consumed. Once used, much of it is gone. At the same time, mining supply is not expanding in any meaningful way. New discoveries are rare. Extraction costs are rising. Political risk in major producing regions continues to grow. And unlike fiat currencies, silver cannot be created by policy decision. Yet, despite these constraints, the price has remained oddly subdued. That's not stability. That's tension. And tension doesn't disappear, releases. The modern financial system is built on confidence in institutions, central banks, clearinghouses, sovereign treasuries. But confidence is not a permanent resource. It erodes quietly, often invisibly, until suddenly it's gone. The silver market is one of the few places where that erosion is becoming measurable. Consider how pricing works today. Spot prices are derived not from physical exchange, but from leveraged derivatives traded by financial institutions with no intention of taking delivery. Price discovery has been abstracted away from reality. When real, world demand rises, the paper market simply expands to absorb it until it can't. This is where risk becomes systemic, because when physical supply tightens while paper supply expands, the system doesn't adjust gradually. Snaps. We've seen early signals already. Delays in delivery, premiums disconnecting from spot prices, increasing pressure on refiners and mints. These aren't anomalies, they're stress fractures. And yet, policymakers remain comfortable. Why wouldn't they? The current structure benefits them. A suppressed silver price supports the illusion of currency stability. It masks inflation, keeps confidence anchored to fiat systems that rely on perpetual expansion of debt. But economics doesn't care about political convenience. The real danger isn't that silver will rise sharply. The danger is what that rise would expose. Because silver doesn't move in isolation, reflects trust or the absence of it. When silver begins to reprice honestly, it sends a message about currencies, about debt sustainability, about the credibility of institutions tasked with maintaining monetary order. That's why this matters. Governments across the world have normalized deficit spending. Central banks have normalized intervention. What was once emergency policy has become permanent architecture. Interest rates are manipulated not to reflect risk, but to preserve solvency. Every intervention pushes the system further from equilibrium. Silver sits quietly in the background, absorbing these distortions. But there's a limit. When real assets are priced through financial engineering rather than physical reality, eventually reality reasserts itself. It doesn't do so gently. This is where many misunderstand the risk. They assume volatility is danger. In truth, stability built on distortion is far more dangerous. Silver's calm is not reassurance, it's compression. There's also a geopolitical layer that cannot be ignored. Global trade realignments, strategic stockpiling, currency diversification are no longer theoretical. Nations are preparing for a world where trust in reserve currencies is no longer universal. That environment, tangible assets regain importance, not as speculation, but as insurance. Silver plays a unique role here. It is accessible, divisible, industrially essential, and historically monetary. That combination makes it inconvenient for systems that depend on control and predictability. And so the pressure builds quietly. Not with headlines, not with panic, but with imbalance. The question isn't whether the silver market will change. It's whether participants will recognize the shift before the mechanisms they rely on begin to fail. Because when trust breaks, it doesn't announce itself. It simply stops working. And when that happens, the repricing isn't measured in percentages, it's measured in realizations. What appeared stable was only restrained. What appeared liquid was only promised. What appeared secure was never tested. And that test is approaching, not with noise, not with drama, but with inevitability. And once it begins, there will be no announcement, only consequences. There's a reason the silver market rarely makes headlines until something breaks. Structure depends on complexity, not transparency. And complexity has a way of concealing fragility. To understand what's happening now, you have to step away from price charts and look at the machinery beneath them. Because markets don't fail due to emotion. They fail due to design flaws that compound over time. At the center of this system sits leverage, quiet, normalized, and rarely questioned. Modern silver pricing is dominated by derivative markets, futures contracts, options, swaps. Instruments that were originally designed to hedge risk have instead become tools to manufacture liquidity. On paper, this looks efficient. Practice, it creates a distorted version of supply and demand where paper commitments vastly exceed physical reality. This structure depends on one critical assumption that most participants will never ask for delivery. And for decades, that assumption held. Institutional traders roll contracts forward, funds rebalance exposure, banks net positions internally. The system functions because movement remains abstract. Silver in physical form rarely has to move at all. But abstraction only works as long as confidence remains intact. The moment participants begin to question whether the metal is actually there or whether it can be delivered on time, in full, and without condition, the entire structure comes under stress. That's not speculation, that's math. Every leveraged market eventually reaches a point where obligations exceed capacity. In equities that manifest through crash, bonds through yield spikes, in currencies through devaluation. In silver, it manifests through delivery strain. And when that happens, pricing mechanisms stop reflecting reality. This is where institutional credibility becomes fragile. Large exchanges and clearinghouses insist that inventories are sufficient. Technically, they're correct on paper. But paper inventory is not the same as available metal. Much of what's counted is already spoken for, pledged, or encumbered through layered claims. The system functions as long as confidence fills the gaps between those claims. But confidence is not infinite. Over the past several years, subtle shifts have begun to appear. delivery timelines extending, premiums separating from spot prices, industrial buyers seeking long-term contracts rather than exposure. These aren't panic signals, they're strategic adjustments. Quiet ones. Because sophisticated participants don't announce concern, they act on it. At the same time, monetary policy has created an environment where distortion is no longer the exception, it's the rule. Central banks have trained markets to expect intervention. Losses are socialized. Risk is suppressed. Capital misallocation becomes permanent. The result is a system that appears stable while becoming increasingly brittle. Silver, in this context, becomes dangerous not because it's volatile, but because it exposes truth. It reveals the cost of currency dilution, reflects the erosion of purchasing power that official statistics struggle to capture. And it does so without rhetoric or ideology. This is why silver has historically been controlled, managed, and at times suppressed, not through conspiracy, but through structure, through incentives that favor leverage over delivery, through policies that prioritize liquidity over resilience. When those policies collide with physical reality, the response is rarely orderly. Consider how modern finance treats scarcity, attempts to neutralize it. Scarcity is inconvenient. It introduces price signals that challenge narratives of stability. So the system creates substitutes, claims, derivatives, synthetic exposure, all designed to simulate abundance. But synthetic abundance collapses the moment someone asks for the real thing. This is where the psychological shift begins. Retail investors are often blamed for volatility, but history shows that structural breaks occur when institutional assumptions fail. When risk managers realize that hedges are correlated. When counterparties reassess exposure. When delivery timelines stretch just a little too far. When that happens, behavior changes quietly, first at the margins, then all at once. What makes this moment different is the broader economic backdrop. Debt levels are no longer theoretical. Sovereign obligations have reached scales that cannot be normalized through growth alone. Servicing that debt requires either financial repression or currency debasement, often both. Interest rates, once a tool of balance, have become instruments of necessity. Raise them too much, and the system fractures. Lower them too far, and currency credibility erodes. There is no comfortable equilibrium. Silver sits directly in the middle of this contradiction. Unlike financial assets, it cannot be printed. Unlike gold, it is consumed. Unlike currencies, it carries no promise, only presence. That combination makes it uniquely sensitive to systemic stress, and that sensitivity is beginning to matter. We are already seeing nations quietly reassess reserves. Trade settlements slowly diversify. Strategic materials become strategic concerns. These shifts don't make headlines because they are intentional and measured. Panic would defeat the purpose. But beneath the calm, a recalibration is underway. The question is not whether silver will reprice. The question is what that repricing will reveal about everything built on top of it. Because when the foundation shifts, the structure doesn't negotiate, it adjusts violently. This is where the psychology of markets changes. Investors who believe they owned assets begin to question the nature of ownership. Institutions that assumed liquidity confront conditions where liquidity is conditional. Confidence, once lost, does not return easily. It's important to understand this isn't about a sudden collapse. It's about a slow recognition that the rules have changed. The system will try to manage it through messaging, through intervention, through narrative control. But narratives cannot create metal. They cannot fulfill contracts. They cannot override physical constraints. They can only delay acknowledgement. And delay is costly. History shows that when trust erodes gradually, people adapt slowly. But when trust reaches a critical threshold, behavior shifts abruptly. The transition feels sudden, but it was years in the making. That's where we are now. Not at the end, but past the point of denial. Silver is not sounding an alarm, it's reflecting one. And what it reflects is a world where stability has been engineered, not earned. Where confidence is maintained by structure, not substance. And where the distance between perception and reality is narrowing. When that distance closes, the adjustment won't be optional, it will simply be necessary. And necessary adjustments rarely arrive gently. There's a moment in every systemic shift when people stop asking what might happen and begin quietly adjusting to what already is. Doesn't come with alarms. It doesn't arrive on breaking news banners. It arrives in behavior. Institutions shorten timelines. Contracts change language. Liquidity becomes selective. What once moved freely now requires approval, explanation, justification. This is how trust recedes, not with fear, but with caution. Silver sits at the center of this transition, not because it causes instability, but because it reflects it. When confidence erodes across currencies, debt markets, and political institutions, tangible assets begin to speak louder than narratives, and silver, historically underestimated, begins to register that shift first. At this stage, it's no longer about price discovery. It's about exposure. The question institutions begin to ask is no longer, what is silver worth? Becomes, what does it protect us from? That distinction matters because protection implies vulnerability, and vulnerability is something modern financial systems are not designed to acknowledge. Central banks operate on the premise of control. Governments rely on predictability. Markets assume continuity. When those assumptions weaken, the entire architecture becomes psychologically fragile. This is where the real pressure builds. When trust in currency erodes, it doesn't vanish overnight. It fragments. People don't abandon systems all at once. They diversify away from them quietly. They seek redundancy, optionality, assets that do not depend on policy decisions or institutional credibility. Silver becomes relevant not because it promises profit, but because it promises independence from promises. That is a subtle but profound shift. It's why responses to silver stress tend to be indirect. Authorities don't confront the metal, they adjust narratives around it. They emphasize volatility. They highlight alternatives. They frame stability as normality, even when underlying conditions have changed. But markets are not persuaded by language forever. When liquidity tightens, when delivery becomes uncertain, when contracts begin to reflect real constraints rather than theoretical ones, behavior adapts. Not dramatically, methodically. That adaptation exposes a deeper issue, one that has little to do with silver itself. Exposes the fragility of confidence-based systems operating without anchor. For decades, stability has been manufactured through coordination between fiscal policy, monetary policy, and financial institutions. This coordination worked because growth masked imbalances. But growth fueled by debt is not growth, it's postponement. Eventually, the cost of postponement surfaces. Silver doesn't create that moment, it reveals it. And what it reveals is uncomfortable. That much of modern finance relies not on value, but on expectation. The expectation that tomorrow will resemble yesterday closely enough for obligations to roll forward. But history doesn't move in straight lines. When systems reach saturation, adjustments occur not because someone chooses them, but because they can no longer be avoided. This is where uncertainty transforms into consequence. At first, the effects appear technical: pricing discrepancies, settlement delays, regulatory adjustments. These are framed as isolated events, temporary issues, manageable disruptions. But over time, patterns emerge. Confidence narrows, liquidity concentrates, risk migrates. And when risk migrates, it doesn't disappear, it accumulates. The silver market, small relative to global finance, becomes a pressure point precisely because of its size. It cannot absorb unlimited distortion. It cannot be endlessly leveraged without consequence. When stress enters this system, it surfaces quickly. That's what makes it revealing. It's not that silver leads the collapse. It's that it refuses to lie about it. At this stage, the most dangerous assumption is that systems will behave as they always have. History shows they don't. They adapt, often abruptly, when thresholds are crossed, and thresholds are not announced. They are recognized only in hindsight. For individuals, this creates a quiet dilemma, not panic awareness, a recognition that trust must be earned, not assumed, that diversification is not strategy if it rests on the same foundations, that ownership matters more than exposure. For institutions, the challenge is far more complex. They must maintain confidence while navigating constraints that confidence itself obscures. They must appear stable while adapting to instability. It's a narrow path, and few manage it gracefully. This is where silence becomes telling. When official reassurances grow more frequent, when messaging becomes more deliberate, when volatility is described as healthy, it often signals concern beneath the surface. Silver reflects this not through spectacle, but through persistence. It holds its value not because of belief, but because of physical reality. It doesn't depend on consensus. That's precisely why it unsettles systems built on perception. The final stage of any financial shift is not collapse, it's revaluation. Quiet recognition that prior assumptions no longer apply, that prices must realign with constraints. That trust must be rebuilt on firmer ground. That process is rarely comfortable, but it is necessary. What comes next will not look like chaos to everyone. Some will adapt early. Others will wait for confirmation that never comes. The majority will only recognize the change once it has already reshaped their options. Silver will not announce that moment. It will simply be there, steady, indifferent, unchanged, while the world around it adjusts. That may be the most unsettling part of all, because when something remains stable while everything else shifts, forces a question few want to confront. Was the system ever as solid as it seemed, or were we simply trusting it to be? The answer is approaching quietly, not with panic, not with spectacle, but with permanence. At some point, every system reveals what it values most, not through words, but through behavior under pressure. When stress appears, priorities surface. Liquidity is protected, risk is redistributed, and responsibility is quietly transferred from institutions to individuals. This is not a failure of morality, it's a function of design. Systems preserve themselves first. What we're witnessing now is not panic, but repositioning. Behind closed doors, balance sheets are being reassessed. Exposure is being recalculated. What once appeared liquid is being reclassified as conditional. What once seemed interchangeable is now being evaluated for reliability. This is the phase few people recognize while it's happening, because nothing looks broken yet. Markets still open. Transactions still clear. Prices still move within familiar ranges. But beneath that surface, behavior has changed. Participants are no longer acting on confidence, they're acting on caution. That distinction matters. Confidence expands systems, caution contracts them, and contraction, even when slow, changes everything. In moments like this, silver stops being discussed as an investment and starts being treated as a reference point. Not because it's perfect, but because it's finite, tangible, and independent of policy decisions. This is where misunderstandings often arise. People assume silver's relevance depends on crisis. It doesn't. Its relevance emerges when trust becomes conditional, when institutions must prove credibility rather than assume it. That transition is subtle but powerful. Because trust, once questioned, behaves differently. It no longer compounds automatically. It must be reinforced continuously, and reinforcement has a cost. For governments, that cost appears in rising interest obligations. For central banks, it appears in narrowing policy flexibility. For markets, appears as volatility that no longer fades as quickly as before. And for individuals, it appears as uncertainty, not panic, but hesitation. Hesitation is where transformation begins. Historically, major economic shifts weren't marked by collapse, but by reorientation. The world didn't end when monetary systems changed, it adapted. But adaptation came with winners and losers, often determined long before the outcome was obvious. This is where silver quietly re-enters the conversation. Not as salvation, not as speculation, but as contrast. Unlike financial instruments, it does not depend on counterparties. Unlike currencies, it does not require belief. Unlike digital abstractions, it cannot be erased or reprogrammed. It simply exists. That simplicity becomes powerful in an environment defined by complexity and uncertainty. This doesn't mean silver becomes dominant. It means it becomes relevant, especially when confidence in systems built on leverage begins to thin. What's happening now is not a rush toward metals. It's a recalibration of assumptions. Investors are beginning to differentiate between ownership and exposure, between access and control, between promises and possession. These distinctions were once theoretical. Now they are practical. The shift is quiet because it has to be. Loud movements attract resistance. Quiet movements reshape foundations. This is why major transitions are rarely announced. They unfold in small decisions made by many actors responding to the same pressures from different angles. A fund adjusts allocation models. A manufacturer secures longer-term supply. A central bank diversifies reserves incrementally. None of these actions are dramatic on their own. Together, they form momentum. And momentum, once established, doesn't require agreement. It carries itself forward. The danger in this phase isn't volatility, it's complacency. The assumption that stability will return because it always has, but history doesn't repeat, it evolves. Each cycle carries new constraints, new imbalances, new limits. What worked before may not work again. This is especially true in a world where debt levels are structurally higher, political cohesion is weaker, and global cooperation is more fragile. Systems built for expansion struggle to operate under contraction. Silver reflects this tension quietly. It doesn't argue. It doesn't campaign. Simply responds to pressure. And pressure is building, not explosively, persistently. The most telling sign is how conversations are changing. Less about growth, more about resilience. Less about opportunity, more about preservation. That shift marks a psychological turning point. Because once preservation becomes the priority, the system has already acknowledged vulnerability. Vulnerability changes behavior faster than fear ever could. This is the phase where outcomes become nonlinear. Small inputs create outsized effects. Minor disruptions cascade. What once seemed stable becomes sensitive. Yet still, there is no alarm bell, because systems don't announce their inflection points. They reveal them only after passing them. Silver doesn't forecast the future, reflects the present more honestly than most instruments can. And what it reflects now is a world quietly repositioning itself. Not collapsing, not panicking, repositioning. And that process is irreversible. When confidence returns, if it does, it will be different. More conditional, more selective, less universal. The era of assumed stability is fading. What replaces it will not be chaos, but recalibration. And those who understand that difference will move differently than those waiting for reassurance. Because reassurance rarely arrives before change, arrives after dressed as explanation. And by then, the real decisions have already been made.